Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today once more, I want us to do CPA 1. I want us to do CPA 1, Financial Accounting, November 2017, question 5B. November 2017, question 5B. This is a question on incomplete records accounting. Incomplete records accounting. Now, many students really fear incomplete records accounting, but I like letting my students know that it is so simple to get 20 out of 20 in an incomplete records accounting, simply because it tests the very basics. It tests the very basics. It tests your ability to understand the double entry rules. Test your ability to understand the double entry rules and therefore do the reconstruction of accounts. You do the reconstruction of accounts. Once again, my name is Samuel Muchai, your tutor in Accounting Made Simple. We kindly ask you to support us by subscribing, liking, sharing, and even hitting the notification bell so that every time we load this kind of videos, we are able to inform you. We also want to urge you to join our online classes. This is what we have done for 16 solid years. I can assure you that we remain the best in our country. Thank you. So we got to the question and we are told, and you can see what I will do is just basically double entries, just double entries to help me reconstruct the accounts. So we are told in the question, David Quare started a business of selling children's clothes on 1st of July 2016. He commenced business with a capital of 14 million shillings. He deposited this amount in a bank account. During the year, David Quare made the following payments through the bank account. He purchased furniture and fittings, salaries, electricity, rent, payment of suppliers, drawings, insurance. Additional information, gross profit is 20% of the sales. Gross profit is 20% of the sales. Total purchases during the year amounted to 8.4 million. Inventory as the 30th of June 2017 was valued at 1.4. Depreciation for furniture and fittings is at the rate of 10%. Accounts receivable as the 30th of June 2017 amounted to 1.4. Rent accrued at the end of the year amounted to 70,000. On 1st of January 2017, David Quare obtained a 10-year loan of 5.6 million shillings. At an interest rate of 12% per annum from the bank. The amount was credited into his bank account. So basically, we just do reconstruction of accounts. So we just come here and we start with our workings. Please ensure that you quickly open every mentioned account. You following the rules, the double entry rules. So we are told, the first thing is, he commenced business with a capital of 14 million. It was deposited in the business bank account. It was not cash. It was deposited in the business bank account. So our bank account receives 14 million. Our bank account receives 14 million. So we call it 14,000 shillings in thousands. And we know when we debit bank and we credit capital. We debit bank and we credit what? We credit capital account. We debit bank and we credit capital account. Yes, as we receive money, we debit bank and we credit capital. We debit bank and we credit capital. In capital we say bank account, and in bank we say capital. Then we are told David Quay made the following payment through the bank. Please see the way to do it. You don't just record the payments, you debit bank as you credit the corresponding account. So purchase of furniture and fittings, here we come, we say furniture and fittings. Furniture and fittings, 2450. 2450. So we create an account called furniture and fittings account 2450. 2450 coming from bank. Coming from bank. Then we are told we pay salaries 399. So we say salaries 399. We create an account called salaries and we debit it. We are creating bank as we debit salaries. As we debit salaries 399 and he's saying it is coming from bank. Then electricity 14. We create an account called electricity account 14 and here we're saying salaries, so electricity. We credit the bank as we debit electricity. As we debit electricity and they say it's coming from bank. Then rent 175. Rent 175. Rent account still from bank 175 and here we say rent 175. Then payment suppliers 5460. 5460 and we are saying this is we are paying suppliers 5460. 5460. So yeah, I will say accounts payable 5460. Accounts payable 5460. If we say here accounts payable, a reduction in a liability, we debit the liability account 5460 through bank. 5460 through what? 5460 through bank. 5460 through bank. Then we are told drawings 210. Drawings 210. Drawings 210. We can actually bring it here and you say drawings account. We're saying it is coming from bank 210. Then insurance at 5. We have insurance how much?
35.
35. Insurance account, we paid insurance 35 through bank. It's coming through bank. So we have insurance 35. Please, I'm reconstructing the accounts. I'm reconstructing the what? The account. Then you're told gross profit is 20% of sales. So we will be able to get that when we go there. Total purchases during the year amounting to 8.4 million shillings. We are paying suppliers here, but we are paying suppliers here because we purchased goods worth 8.4 million shillings. 8.4 million shillings. So we debit purchases, when we buy on credit, we debit purchases with 8,400 and we credit accounts payable with purchases account 8,400. When we buy goods on credit, we debit purchases and we say it's going to accounts payable. And that's what we are paying later. That's what you are paying later. And therefore our liability was 8.4 and you can see how much you are paid. And therefore you can see how we are going to get the balance carried down for accounts payable. We are doing double entry the normal way. Purchases, you debit purchases as you credit accounts payable. When you pay the accounts payable, you debit accounts payable as you credit bank. Simple, following the double entry rules. Then we are told inventory was, I like telling students, even when you are getting closing inventory, just write it somewhere. Write it somewhere that we have closing inventory, so that all the information that you need for your answer is available. Our closing inventory is 1.4, 1,400. All the information is available. We are told depreciation of furniture is provided 10%. Furniture depreciation expense is 10% of the furniture cost, which is 2450. 2450, let me write it well. 2450 of 2450, which is equal to 245. Depreciation is 245. Then you are told accounts receivable as of 30th of June 2017 amounted to 1.4. Amounted to 1.4. We are told that the accounts receivable as at the end of the year, 30th of June 2017, is 1.4. If we were to create an accounts receivable account, I don't want to touch this area so I can get the answer from there. We can get the answer from there. Let me try to get the accounts receivable account there. Accounts receivable account. We are told that the balance carried down. Always remember where you capture it. Balance carried down is 1,400. 1,400. We are just put it where it's supposed to be. Just put it where it's supposed to be. We are told the balance carried down is 1.4. Rent accrued as the 30th of June is 70. So rent is not just this. We have rent which has not been paid. Amounting to 70. And therefore, 245 becomes the total rent, which we take to P&L account, 245. But we know we have rent payable. This is rent what? Rent payable. It is not paid. If it is accrued, rent payable. If it is accrued, it means it has been incurred but has not been paid. It has been incurred. And we recognize expenses when they have been incurred and revenues when they have been earned. Not necessarily when the expenses are paid or when the revenues have been corrected. So we have a rent payable of 70,000. Then we are told on 1st of January 2017, David Quare obtained 1st of January 2017. You must notice that 1st of January 2017. If we were to do that number line, our year ends 30th of June 2017, 30th of June 2017, and therefore it starts on 1st of July 2016. So the middle here is 1st of January 2017. 1st of January 2017. And that is when we are acquiring a 10-year loan of 5.6 million shillings at an interest rate of 12% per annum from the bank, and the amount was credited into his bank account. So we credit bank with 5,600, we credit bank with 5,600 as we debit loan account. And this is a 12% loan, and therefore we can create a loan account here, loan account, and you're saying it is coming from bank, and the amount is 5,600. 5,600, and therefore loan interest, we can actually say that our loan interest, it is 12% of 5,600. 5,600, and you can see we have not paid it anywhere. From the information given, we have not paid this interest. So it's an expense and a liability. It is an expense and a liability. It is both an expense and a liability. It is both an expense and a liability. So if you were to say, 12% of 5,600, 0.12 of 5,600, we get a figure of 672. We get a figure of 672. So our loan interest is 672. Our loan interest is 672. But we should do it for half, because because it is beginning in 1st of January, so it is only there for 7 months. It's only there for 7 months, and therefore we say it should be not 672, it is 672 divided by 2. 0.12 times 5600 times 0.5. We get a figure of 336. We get a figure of 336. We get a figure of 336. That becomes our loan interest expense. It is both an expense and also a liability. It is both an expense and also a liability. Now, we are told that the accounts receivables as at the end is that. So if we look at that, and our learned to include accounts receivable and first of January, we need to find out how much money we made on our sales. We need to know how much money we made on our sales and how much we collected. We need to find out how much we made on our sales and how much we collected, so that we can get the figure to capture here as our sales. We can get the figure to capture here as our sales, and we know that in accounting we say sales, which is, if we say that our sales is X less cost of goods sold. Our cost of goods sold is purchases. We don't have opening stock, so we get purchases. Our purchases, we said, is how much? 8,400 from the purchase account. Our purchases is 1,800 less closing stock. Less what? Closing stock 1,400. We get a figure of 7,000 as the cost of goods sold. We get a figure of 7,000 as the cost of goods sold. We get the figure of 7,000 as the cost of goods sold, and therefore we are being told something. The statement that we are told that gross profit is 20% of sales. Our gross profit here is 20% of sales. If sales is X, our gross profit is 20% of sale of X. Our gross profit is 20% of X. Our gross profit is 20% of X. And therefore we are saying X minus 7,000 is equal to 20% of X. In accounting we say sales less cost of goods sold, and cost of goods sold is purchases, opening stock, add purchases less closing stock. We don't have enough hard opening stock, so we say purchases less closing stock, we get 7,000. Sales minus the cost of goods sold, we then get the gross profit. So we say X minus 7,000 is equal to 20% of X. And therefore, if we bring the X's together, we say X minus 20% of X is equal to 7,000. Is equal to 7,000. And therefore, which therefore implies 100 over 100X minus 20 over 100X is equal to 7,000. And therefore 20 minus 20, 100 minus 20, 80X. 80 over 100, 100 minus 20 is 80. 80 of 100X is equal to 7,000. Multiply by 100 over 80 both sides. We say X, therefore implies X is equal to 7,000 times 100 over what? Over 80. We get a figure of 7,000 times 100 divided by 80. We get a figure of 8750. We get a figure of 8750. Get a figure of what?
It's 750.
It's 7. So we are saying X, our sales is 8750, And our gross profit is 20% of 8750. Our sales X, our X, which is this one, is 8750. And our gross profit is 20% of 8750. So we can actually get those figures now. Point two of 8750 is 1750. Our figure here now is 1750. Our figure there is 1750. And our figure here is 8750. 87 what? 50. So we get our gross profit there as 1750. You get our gross profit there as 17 what? So our gross profit is there, our sales is there. We are saying we made sales amounting to 8750. If we now come back here, we are saying once we make sales, and we are assuming that we are making sales on credit, if we assume that we are making sales on credit, we are saying we credit sales account with 8750, and we are taking it to debtors, trade debtors. We are taking it to trade what? So we come to our debtors, we debit debtors with 8750 as the 750, and we are saying it's coming from what? From sales account. From sales account, and therefore we sold on credit. That's why we have accounts receivable as one of the items. We sold 8750 and our balance is 1400. So how much did we collect? Out of 8750 minus 1400, which we had not collected at the end of the year, we are making 7350. So we are collecting through bank. We are collecting through what?
Bank.
Bank, we are collecting 7350. We are collecting 7350 through bank. So we credit accounts receivable as we debit bank with 7350. As we credit bank with 7350, coming from accounts what? Coming from accounts receivable. Coming from accounts receivable. And that way we cannot close all our accounts as we prepare our income statement and balance sheet. So if it's this is bank, let's try to close bank. 14123 plus 5600 plus 7350, we get a total of 26950. You get a total of 26 what? 26950 minus 2450 minus 399 minus 14 minus 175 minus 5460 minus 210 minus 35, we get a figure of 18, just a minute, 26950 minus 2450 minus 399 minus 14 minus 175 minus 5460 minus 210 minus 35, we get 18207. We get a figure of balance carried down of 18207. 18207, 26950. This one is, there is a straightforward. Accounts payable balance carried down. Balance carried down for accounts payable, 8400 minus 5460. We get a figure of 2940. We get a figure of 29 what? 2940, insurance, purchases, payable, closing inventory, furniture, salaries. So quickly, we now go to our income statement back. We know how to start to title the income statement. We call it David Quare. David Quare income statement. We call it David Quare income statement. David Quare You know how to put it. David Quire income statement. David Quire, the first line, income statement, the last line, for the year ended 30th of June 2017. So here we say less expenses. We say less what?
Expenses.
We say less expenses, and we go back to our workings. And that's why I like saying, capture everything in the course of your reconstruction. Even whatever you are not, like this one, you're not adjusting at all. Capture it, because once you capture it, you'll be able to quickly extract the information. You will capture it very, very fast as you save time, but you'll be able to capture that information now as you prepare you have the source of your information as you prepare your financial statements. So we look for expenses. This is not expense, this is not an expense. This is not that. We have interest expense, 336. Interest expense, 336. And you know it's also a current liability. You know it's also a current what? Capital loan is not an expense. 116 drawing is not an expense. Salaries 399. 399. Electricity 14. Rent 245. Accounts payable, insurance 35. Nothing, purchases, accounts, depreciation, furniture and fittings. It is 245. And those appears to be our expenses. Those appears to be our expenses. So all we need to do is to add them up. We add them up. 336, 399. 336 plus 399 plus 14 plus 245 plus 245 plus 35 plus 245 336 plus 399 plus 14 plus 245 plus 35 plus 245, we get a figure of 1274. Get a figure of what? 1274 total expenses. Don't be in a hurry to miss reconstructing the accounts, because once you do that, extracting the information becomes very easy because you are looking at the same place. 1750 minus 1274 minus 1750, we get a figure of 476. Our profit for the year becomes 476. Our profit for the year becomes 476. Our profit for the year becomes what? 476. So we erase so that we can get space to get to do the balance sheet. We erase that, but that's the way to do the income statement. That's the way to do the income statement. Then we erase to give us a place for the balance sheet, to be able to prepare our balance sheet. Daniel Quire statement of financial position as at 30th of June. Daniel Quire statement of financial position. Daniel Quire statement of financial position. As at 30th of June 2017. And we know the only non-current asset we have is furniture and fittings. The only non-current asset we have is what? Furniture and fittings. Furniture and fittings. And we are saying there is cost, there is provision for depreciation, and there is net what? There is net book, value. And for furniture and fittings is our purchase cost for furniture and fitting is 2450. So 2450 shillings in thousands. Everything is shillings in thousands. Shillings in what? Thousands. So furniture and fitting 2450, and the depreciation we change to 245. 2450 minus 245. 2450 minus 245. We get a figure of 2205. We get a figure of 2205, and therefore total non-current assets. Total non-current assets is 2205. 22 what? Or 5. Then you say current what?
Assets.
Current assets. We say remember the format in the head. Your format must be in the head. Your format must be in the head. Your format must be in the head. And the first item in current assets is always inventory. It's always inventory. And we say our closing inventory is 1,400. So we say inventory is 1,400. 1,400. It is all here. It's all here. It's a matter of just picking and bringing it there. Then we say accounts receivable. Accounts receivable, we say the balance carried down of accounts receivable is 1,400. So we say accounts receivable is another 1,400. Another 1,400. Our accounts receivable is another 1,400. And we now ask ourselves, from there, do we have any prepayments? This time around, we don't seem to have any prepayments anywhere. We never talked about prepayment anywhere, and therefore you don't capture it. From the prepayment, we come in the order in the head, our format in the head. Inventory, accounts receivable, other debtors, prepayments, investments, bank, cash. So we come to bank, and our bank balance is 18,207. Our bank balance is 18 what? 207. Our bank balance is 18,207. Our bank balance is 18,207. We do not have cash. We do not have cash. So we add the 2,800 plus 18,207. 207. We get a figure of 21,007. We get a figure of 21,007. 21,007 as our total current asset. Total current what? Assets. Then we get total assets. You get total what? Total assets. You add the total non-current assets to total current assets to get total assets. So you add 2205 plus 2205. We get a figure of 23,212. 23,212. 23 what? 23,212. That becomes our total assets. We say, where did we get the assets? We say financed by, and we say capital and liabilities. We say capital and what? And liabilities. Capital and liabilities. And we know our capital. We know our what? We know our capital because we created our capital account here with 14,000. We have our capital account there with 14,000. Then we ask ourselves, how much was the profit? We add the profit. That's from the format. That's from the format. We add our profit and we say that our profit was how much? What was our profit? What was our profit? We say that our profit was 476. Our profit was 476. So we add 476. We add 476. We get 14,476. Then we ask ourselves, did we have drawings? Did we have what? And we had drawings which amounted to 210. We had drawings which amounted to 210. So we say less drawings. We say less what? We say less drawings, which is 210 minus 210. Minus 210. 23 So 14,476 minus 210, we get a figure of 14,266. We get a figure of 14,266, and that becomes our closing capital. That becomes our closing what?
Capital.
That becomes our closing capital. Then we come and we say non-current liabilities. Non-current liability. These are the long-term liabilities. These are the long-term liabilities that which are loans. And we said we had a loan of 12%, 5.6. 12%, 5.6, and it is here. Loan account 5,600. 12% loan, and we said it is 5,600. Then we go to current what? Current what? Liabilities. And remember the format for current liabilities. We start with the bank overdraft, we come to accounts payable, we come to other creditors. And we don't have bank overdraft, but we have accounts payables amounting to 2940. We have accounts payables amounting to 2940. Accounts payables amounting to 2940. So we come here, we say accounts payable is 2940. Is 29 what? Then we ask ourselves, do we have other liabilities? We have other liabilities. And we know our loan interest, we said it's unpaid, 336. Loan interest payable. Loan interest payable. Interest payable, we said it is 300 and that is what? 36. That is not paid. Loan interest payable, 336 is not paid. We also said we have rent payable amounting to 70. Rent payable. We have rent payable amounting to what? I'm just picking the information. Once again, I want to urge you, this is how we know best and what we know best to do. Kindly like, share, subscribe, invite your friend, tell them about the good news that we are now online and we also be offering online classes. Thank you very much as we finalize on this one. Rent payable, we say rent payable is 70. Rent payable is 70, accounts payable we have captured. Insurance, it's not a payable, we have purchases, not a payable. Closing, I don't think there's anything else. So we add those, we add them up, and we get 2940 plus 336 plus 70, we get a figure of 346. We get a figure of what? 346. Total current liabilities. Total current liabilities. I want to repeat again, the format you see me use is the format required by International Accounting Standards 1 on presentation of published financial statements in financial reporting. So it's very, very important that you follow the format the way I am doing it. It's very, very important. It prepares you to pass published accounts in financial reporting, section 3. So if we do it that way, we add 346 plus 5,600, the non-current liabilities, plus closing capital of 14,266, we get 23,212. We get 23,212, and that is total capital and what? And liabilities. Total capital and liabilities. Total capital and liabilities. And 2312 is the same as total assets, 2312. This is the way to do it. Kindly like, share, subscribe, invite your friends to join us, and join our online classes. I want to assure you, we are simply the best, and you will not be disappointed for joining us. Our number is scrolling on this channel, and we'll be glad to hear from you. Speak to us, give us feedback, give us whatever you feel you want to tell us. Thank you very much.